Look at the screen right now. Silver is falling hard. Red candles everywhere. Sharp drops. Panic-inducing numbers flashing across your trading app. Your heart's probably racing a little. Maybe you're questioning everything, but here's where it gets weird. Step outside that screen for a second. Try to actually buy physical silver right now. Go ahead. Check your local dealer. Check the big online platforms. What do you find? Out of stock premiums that refuse to budge. Delivery times stretching longer and longer. Wait. How does that make sense? If this were a real selloff, if silver were genuinely being abandoned, physical metal would be flooding the market. Prices would be soft everywhere. You'd be tripping over bars and coins, but that's not what's happening. Only the paper price is collapsing while the real world price holds firm. That tells you something immediately. This move, it's not about supply and demand. It's about psychology. What you're watching is what I call a vertical paper event. A sudden wave of selling that appears out of nowhere, hits strength and liquidity, and vanishes just as fast. That's not how miners sell their production. That's not how long-term holders exit positions. That's how fear is manufactured. The purpose is brutally simple. Make you doubt the story you believed yesterday. Make you question whether you're early or, worse, wrong. And that leads to the only question that actually matters right now. If this drop is unnatural, then who needs you to panic? And why now? Stay with me here, because once you see this mechanism, you can't unsee it. You have to stop thinking in terms of bars and coins for a minute. Start thinking in contracts. The silver price flashing on your screen isn't set by physical metal changing hands. It is set by paper promises trading at extreme leverage. In a market where claims on silver outnumber real ounces by a staggering margin, we're talking dozens of claims for every actual ounce sitting in exchange vaults. Some estimates put it in the hundreds. That's not conspiracy theory. That's the actual structure of the market. And it creates a weapon when liquidity is thin, holidays, weekends, off hours. Massive blocks of paper contracts can be dumped in seconds, not sold carefully, not worked over time to get the best price, just dumped all at once at the worst possible price. No rational owner of silver would ever do that. Anyone holding real metal wants the highest price, not the lowest. So who sells like this? Only one type of participant, someone who doesn't even own silver. Someone who's short, someone who profits when the price collapses. This is why the drops are so violent, so fast. Real selling takes time. Manipulated selling is instantaneous. The goal isn't to exit a position, it's to trigger margin calls and panic selling from everyone else. Fear does the rest of the work for them. And once you see that mechanism clearly, the next question becomes unavoidable. If this is engineered and not organic, why was it deployed now? Because the timing is where this entire narrative falls apart. Just days ago, new export controls out of China went live. Real restrictions tightening the flow of refined silver and other strategic metals to the rest of the world. And China isn't some minor player here. They sit at the center of global refining and supply chains. When a supplier of that magnitude restricts exports, basic economics says prices should move higher, not collapse into the ground. In a functioning market, that kind of supply shock would trigger an immediate repricing. Buyers would rush in to secure material, sellers would demand more, the curve would gap upward. Instead, we got the exact opposite, a sudden aggressive sell-off. That contradiction tells you everything. Markets don't crash on good supply news unless price discovery is being overridden. What you're seeing isn't a verdict from the market, it's a distortion imposed on it. Someone stepped in and forced the price lower precisely when the fundamentals demanded the reverse. That's the trap. The paper price is screaming abundance at the exact moment physical supply is being squeezed. And when price lies at turning points like this, it's never accidental. Which brings us to the real test of truth, not the chart, the physical market itself. Here's where the paper narrative completely breaks down. If silver were truly collapsing, you'd be able to buy it as early and cheaply right now. But that's not what's happening. Walk into a local dealer, check the major online bullion platforms. Same story everywhere. Limited inventory, elevated premiums, delivery delays, that just won't go away. This is the difference between screen price and street price. Screen price is the number attached to a leveraged paper contract that might never touch actual metal. Street price is what real people pay for real ounces, right now, and the street price is not confirming the crash. Physical holders aren't dumping metal. They're sitting tightening many because they're actually adding to their positions. That tells you confidence hasn't cracked, it's hardened. When paper prices get smashed but physical supply doesn't loosen up, it signals stress in the system, not weakness. It means the market is rejecting the discount. Every artificial price drop has the same unintended effect. It pushes more silver into what we call strong hands. People who understand this disconnect use these moments to accumulate, not liquidate. The cheaper paper price becomes an incentive to hoard, not to sell. And while retail investors quietly do this at the margins, something much larger is happening beneath the surface. Because the most aggressive buyers in this market, they're not watching YouTube charts. They're securing supply for survival. While retail traders stare at red candles, the most important buyers in the silver market aren't looking at charts at all. They're looking at factory schedules, supply contracts, production deadlines. For them, silver isn't a trade. It's a critical input. Without it, assembly lines stop, electric vehicles, solar panels, semiconductors, AI servers, advanced weapon systems, all of them depend on silver's unmatched conductivity. And that demand isn't optional. You can't just swap it out for something cheaper. You can't delay it indefinitely. If the metal isn't there, production fails. That's what makes silver demand inelastic. What's changed is how these companies think about supply. For decades, global manufacturing ran on just-in-time delivery, keep inventory minimal. Metal flows freely. That system is breaking down. With export controls, tightening in supply chains, fragmenting, procurement teams are shifting to just instead of weeks of inventory. They want even years. And here's the kicker. New solar technologies are amplifying this pressure. Advanced panel designs now require significantly more silver per unit than older models. And most of that manufacturing is concentrated in Asia. When supply tightens at the source, downstream users feel it immediately. So when the paper price gets smashed, these buyers don't hesitate. A lower quoted price is a gift, a chance to lock in physical supply before availability vanishes. And once that silver enters industrial vaults, it doesn't come back, ever. This is where the story stops being just about markets and starts being about power, resources, and geopolitics. To understand why silver can't stay cheap, you have to zoom out beyond markets and look at geopolitics. The world is quietly moving away from a system where Western consumers dictate prices through paper exchanges. Commodity producers are reclaiming control, and they're doing it outside the dollar. Energy trade is the clearest signal. When major producers begin settling oil flows directly with China and yuan instead of dollars, it weakens the foundation of the old system. For decades, global demand for dollars was enforced through energy pricing. That demand is now leaking away. And when excess dollars lose their outlet abroad, they call me home, pushing inflation and eroding purchasing power. In that environment, hard assets regain their role. Central banks aren't buying tech stocks or bonds to protect reserves. They're accumulating metal. Gold leads, sure, but silver sits directly in the production chain of modern economies. It's both money and necessity. The power dynamic is shifting. The East produces commodities. The West consumes them. Producers want higher real prices, not suppressed paper values. As more trade bypasses Western financial infrastructure, the quoted dollar price becomes less authoritative, less meaningful. This creates a floor under silver that paper sell-in simply cannot break. Every artificial price smash just transfers metal to actors who do UNT care about Western market signals and woo UNT sell it back. And that leaves Western banks in an increasingly impossible position. This is where the system turns on itself. Banks that are structurally short silver depend on one thing above all else: time to roll contracts, time to discourage delivery, time to convince the market that metal is plentiful. Price suppression is how they buy that time. But the tactic is backfiring spectacularly. Every time the paper price is forced lower, it sends the wrong signal to the wrong audience. Instead of shaking out real holders, it attracts strategic buyers, sovereigns, industrial users, long-term accumulators who see cheap silver as an opportunity, not a warning. Physical demand rises precisely because the price is being suppressed. That creates a feedback loop. Lower prices accelerate hoarding. Hoarding drains inventories. Drained inventories increase delivery risk, and increased risk forces even more aggressive price suppression. Each cycle makes the imbalance worse. The irony is brutal. The banks push the price down to avoid a physical reckoning, but the act of doing so guarantees that reckoning arrives sooner and with greater force. Paper leverage grows while real metal disappears into vaults. This is not a stable system. It only works as long as confidence holds and physical holders cooperate. Once confidence breaks, once enough participants refuse to sell, the loop snaps. And when that happens, the consequences fall fastest on those least prepared, which brings the focus back where it belongs. Your position in this setup. This is where most people lose. Not because they're wrong about silver, but because they react to the wrong signal. The spot price is not your guide right now. It reflects a leveraged paper market under stress, not the value of the metal you actually hold. Watching every tick only feeds the emotional trap that price suppression is designed to create. The honest signal is elsewhere. Watch premiums when the quoted price drops, but physical silver still sells at a markup. That divergence tells you scarcity is winning. It means the real market is refusing to cooperate with the paper one. That's second thing. Avoid leverage. Leverage is how this system cleans people out. If you're forced to sell because of margin calls, you never get to see the resolution. Owning silver outright without debt turns volatility into noise instead of danger. Third, change your unit of measurement. Dollars are the unstable variable here. Ounces are not. If you hold the same amount of metal today as you did yesterday, nothing real has been lost. Paper prices fluctuate. Physical properties don't. Patience here isn't passive. It's active resistance. By refusing to sell and to manufacture fear, you remove supply from a system that desperately needs it. Institutions may be panicking behind closed doors, but you don't have to. Because once positioning is set, the only thing left is the repricing. And that's where this story ends. Moments like this don't announce themselves clearly. They arrive disguised as confusion, distorted prices, conflicting signals, engineered fear. But step back and the alignment is unmistakable. Physical supply is tightening. Geopolitics is fragmenting trade. Industry is quietly locking in metal. And the financial system is leaning on leverage. It cannot honor forever. These conditions don't resolve slowly. They stretch, they distort, and then they snap. Repricing doesn't happen in a straight line. It happens in sudden gaps when confidence breaks and paper promises collide with physical limits. By the time the move is obvious to everyone, positioning is already done. That's why this window matters. Not for speculation, for preparation. Staying informed means looking past headlines. Staying unleveraged means refusing to play a game designed to force you out. Staying physical means holding something that doesn't depend on permission, trust, or someone else's solvency. You're not alone in this. There's a growing group of people choosing substance over signals, ounces over optics, reality over narrative. That community grows quietly until it doesn't. If this breakdown helped you see the setup more clearly, stay connected. Share this with someone who needs perspective right now. Because when the distortion finally ends, there won't be time to explain what happened, only time to live with the results.